You never really choose the mortgage business. It kind of chooses you. What I've also found, whether it's a first timer or somebody who's done it 15 times, there's so many psychological barriers that get in our way, whether it's for the good or for the bad.
It's terrifying.
It's freaking ugly.
Yeah.
But then you come back to, what is my alternative? So this loan creates a situation where you're so quickly paying down your mortgage, but you don't lose that access. So and this is a great time to tell you, it's never had a default. It's been out since 2005. The loan's never had a default. How can that be?
All right, welcome back to the Tim Teaches podcast. I'm your host, Tim McCoy. Today's episode is a little bit different than our usual conversation. We're talking about financial freedom, something that impacts our stress, relationships, and ability to live on purpose. Today, I have the pleasure of being joined by Michael Newman, a seasoned mortgage originator with CMG Home Loans. Michael has over 20 years in the mortgage finance business. Additionally, Mike, you're a father. You were a coach. You have a degree in psychology, which I imagine comes in handy when you're trying to sell people on mortgages. Mike, thanks for joining me, buddy.
Yeah, absolutely. Thanks for having me. I appreciate it.
Yeah. So 20 years in the business, that's a long time. How'd you even get into the mortgage business?
Kind of like anybody else, you never really choose the mortgage business. It kind of chooses you. So so I was a collegiate athlete once upon a time, student athlete, and finished up my degree at UC Davis, and in kind of an emphasis in sports psych, which kind of flows into business psych, performance enhancement, team cohesion. So it really flows into business. Floundered for a little bit. Kind of like a lot of college graduates, we think we write the ticket. I graduated with highest honors, and I thought, oh yeah, I'll be able to get this, big paying job. Came back to the valley that I grew up in here in the Rogue Valley, and realized real fast that that's not really the case. So I floundered a bit, and when I was floundering, I called on I call her my spiritual mom, Mary, and she offered me a job. I came in, I think I was selling advertising at the time. And
Yellow Pages?
No, I don't even remember what the heck it was. But anyway, so she offered me she's like, I'm not going to buy what you're selling, but I think you'd be really good in this business, the mortgage business. And I was like, okay. And so she offered me a job. I didn't take it at the time. Long story short, another year passed. I was intrigued. Through a sequence of events, decided I was going to go down that road, and lo and behold, I went back and asked if it was still available, and she said absolutely, hired me on the spot, and the rest is history.
20 years ago. So yeah. I didn't know you spent time in Davis. I had an address in Davis for about a year and a half on Pole Line Road.
Okay, yep.
2400 Pole Line Road,
yep.
And at the time I was in the military, but okay. I paid the rent of somebody that lived there.
Okay.
And so that was my physical address. I got to go there a couple times. Beautiful area.
Yeah, I enjoyed it. It was a great place to go to school. It's changed a ton since I've been there. But yeah, as far as the psychology degree, it was it was very eclectic. I learned from some of the most famous child development psychologist that wrote like the book Baby Signs. I don't know if you're familiar. Very fascinating, lifelong study for them. And then wrote this book about how babies they can't articulate, right? But they speech, but they need to communicate. And so giving them simple signs, kind of cute. We've seen them in the movies.
Yeah, I've seen that. It's crazy. You can teach a kid how to do sign language before, they're like, hungry. Yeah. It's crazy.
Yeah, it's so anyway, that was fascinating. So anywhere from the child development psychology to, some leading sports psychologists that actually worked with businesses as well, big corporations and stuff to help their teams and cohesion and performance enhancement. So it was all over the board. It wasn't just a lot of people, when you hear psychology, they immediately go, oh, so are you psychoanalyzing me right now? And it's like, that was one class.
Yeah.
So it was really good. And I was headed towards sports psych, and in a master's degree. I was accepted in a master's program at Cal State Fullerton to study under the late Dr. Ken Ravizza, which was he's famous sports psychologist who's unfortunately passed. But and then just life took a turn as it can, and so anyway.
Did you play ball down there? Or
Yeah, so I played. I actually started in Riverside, California, at a junior college, Riverside Community College, and then through a sequence of events, ended up on scholarship at UC Davis. Played there, didn't quite turn into the career that I anticipated it to be, as tends to happen with most. But man, it set the platform for what I've been fortunate and blessed enough to achieve in my life.
how did you start playing ball? I know we're talking mortgages, but I'm going to learn a little bit about you today,
Yeah,
Mike.
for sure. Yeah, so my dad's side of the family, and mom's side too, but predominantly my dad's side of the family is very, very athletic. So it was like I knew and I was a firstborn on either side of my family. So I knew that sports were a big emphasis, and that I think I learned early that was how I was going to get attention from my family and acceptance ultimately. And so I started, I was a 3-sport athlete all the way through high school. Football was kind of our thing, my family's thing. My uncle was an All-American at Boise State, national champion in the early '80s, and then Grandpa played in the service, both football and basketball, and then he ended up coaching at the University of Redlands football for years, and is in their Hall of Fame and all that kind of stuff. So the football ran really deep. And I almost went and played both in college, but baseball's really where I got a lot of attention. And so, yeah, I probably started playing organized sports. I think it was in the 3rd grade.
Wow.
And it was pretty much all the way through.
And you kind of passed that along to your son, who's doing fantastic things right now.
So Trey didn't have too much of a choice. My firstborn boy. He came home from the hospital in a baseball uniform.
All right.
So he was, I was coaching a high school program. So in the midst of all my career and everything, I've always been, baseball is something that is a big part of my life. And so I was coaching, very early on, and then I got an opportunity to take over I ran for the head job at my old high school, and that was a dream come true that happened way sooner in my life than I thought it would.
How old were you?
Oh shoot, young. I don't even remember how old I was. I think so. It was in 2000. I think it was like 2007, 2008. Do the math there on the mortgage industry and real estate. Not great timing.
Yeah. Well, that gave you something to focus on besides mortgages.
It did for sure. It didn't help me financially, however, because as most that coach know, it's at least at the high school level or below, it is not you don't do it to make money, for sure. But it was a joy. So I took that job, and Trey was just a little guy. My son. And so he was just a little guy, but old enough. So he came with me to all the practices and followed me around. He was our bat boy. So he's just always been around the game. I didn't allow him to play organized until he was 9 or 10 years old.
Oh, wow. Why?
I'm kind of funny that way. This might offend some people. I think T-ball and stuff is more for the parents.
Yeah.
It's just organized chaos, and a lot of times the kids don't even want to be there. So I felt like I could do more with him at home, and really kind of inspire, if he was going to go that direction, a passion through just, teaching him, throwing the ball to him, playing catch, that kind of stuff and that seemingly worked. So he's still playing college ball and chasing the dream, and gone a lot further than I did.
And all the T-ballers that were playing, I would imagine. I mean, that's so obviously you made the right choice. I mean, I'm kind of in that boat right now where I have a young son, as you know, and he's just started playing soccer, but he's every time he does anything, he's just looking over at me like, "Hey, Dad, how's it?" Yeah, I'm like, "Dude, focus on the game." And then part of me is like, "Is this for me or is it for him?" So I kind of question that. But.
Yeah, it's hard because society these days, I was just listening to a sermon this morning. It was just talking about how hard our kids have it, with just the comparison with, social media and all the things that is just in their face. You know, it used to be you go to a couple practices a week, and that's what, you know, that's how it was. Now, if you're not practicing 8 days a week, right?
Yeah. And these guys are traveling all over
Yep.
the state. And
Yep.
it's crazy. I know so many people who, you know, their teen is in, you know, girls softball leagues, and every single weekend they're on the road. And, you know, I think it's for the parents.
Yeah, to each his own, for sure. I mean, we got involved and wrapped up in the travel ball thing for a minute, for sure. And it was really great until it wasn't. And you know, I remember having a really candid conversation with my son. He was about, I think he was about 11, 12-ish years old. And I was just like, you know, this is not good. This is not good. This is actually gonna burn you out. And this is, we need to take a step back from this. There's just some indications that I was like, yeah, this is not going the direction I wanted. So we took a step back from it. And that ended up helping a lot. Also, I took a step back from coaching my son. I had coached him through a lot. And again, as some of us are, we're kind of hard on our kids, maybe harder than we should be. And I recognized that. And I felt like, you know what, I need to step back for a minute and let other people coach my son for a while. And I didn't step back in until he begged me to, basically his junior year of high school. So
Do you think that was based on you're just being a dad and having that intuition, or did it have anything to do with your psychology degree? Or
100% had to do with the psychology. Yeah. It was definitely, because, you know, in sports, as in life, but especially sports and high performance, you're this guy's the one that gets in the way. And so, you know, being hard on your kid, or coaches that are not necessarily having the best interest of your kid first and foremost, and teaching, you know, I've always told my guys, I'm here to teach life through the game of baseball. The biggest failure sport there is. It mirrors life like no other. And I was fortunate enough to be coached by a few coaches that were that way, that instilled that in me, that they were teaching life. Now, unfortunately, that's few and far between of coaches that actually do that. They're more about how do we win at all costs, whether it injures the kid or not. And lo and behold, you know, my son had a shoulder, you know, tore his labrum, you know, early on in high school. And I wonder how much of that was from early days in travel ball, where they were just overusing him, just taxing him, you know. So,
well, we're not specifically here to talk about mortgages, but we are specifically here to talk about mortgages, but not baseball, but psychology and sports. And man, so I know I got into the mortgage game very early on, and was offered a interest only, you know, back in 2008. It was probably the worst financial decision I could have ever made at the time. I had no idea what I was getting myself into. It seems to me that they don't obviously teach a lot of this stuff in school. And so a lot of people come into first time home buying without any knowledge of mortgages or finances. I assume you've worked with a ton of people who are walking through the door the first time.
Yeah, lots.
So what is kind of your initial steps with somebody like that, when somebody walks through your door and says, Mike, I want to buy a house, and we have, you know, $50,000. We got our 20% down. How do you guide that person? Do you ever look at the person and go, listen, you know, I think this is a good opportunity for you to buy a house, but maybe you should look at doing it this way, or how do you guide people?
Yeah, for sure. That's a conversation that's had for certain. So one of my practices is making sure. So we get everybody dialed in, pre-approved, as they say. And then I sit down, and typically it's a conversation like this. We're sitting down in my office or on a video. And we're going through and I'm educating them. I'm getting to know them. I'm understanding what it is that they're trying to accomplish. And more than anything, I tell people, you might qualify for this, but what are you really comfortable with? And why is it that you're comfortable with that? Because what I've also found, whether it's a first timer or somebody who's done it 15 times, there's so many psychological barriers that get in our way, whether it's for the good or for the bad. In other words, more conservative or more generous. These barrier. I mean, there's like, for instance, numbers. A price tag on a house. So certain people hear 500,000, and that's just a no way.
Yeah.
And some people hear, and other people it's 1 million. No way. I mean, those are large numbers to think about, but I try to break down, relative to what are these numbers. So I really walk through and try to get to the bottom of their comfortability and where they want to go. So with first timers, it's tough because sometimes they have zero filter. Or even worse is when they've gone online and they've started researching online, because there's so much misinformation and misunderstanding about how this thing works. And that's really dangerous. So they know just enough to be dangerous, and it gets them in trouble, in my opinion, sometimes. So, and there's just, like you said earlier, there's no education.
Yeah.
There's none. We don't learn in school about money.
Yeah.
I mean, very, very, few times do you hear people say, I actually even talked about money.
Yeah.
In school. And it's like, wow, what a failure on our,
Yeah.
on our part, on our.
I mean, I didn't know, amortization schedule. You're like, I'm going to buy a house for, $200,000, and then you look at the whole picture and you're paying, $400 or $1,000. It ain't $200,000 that you're paying. It's a different number, and there's different ways, obviously, of writing off interest and stuff, but
it's a lot to it. And and that's funny that you say that. So most people don't look at those numbers.
Yeah.
And you don't, because what's your alternative?
Yeah.
If you want to buy a house and you're going to buy it for $300,000 and you don't have $300,000 sitting around, most don't even have 20%. And people, that's another topic, is, people assume that you need 20%. Well, that's not the case. We can, if you're a veteran like yourself, you're able to do 100%. There's other programs too with very small down payments. Minimum 3 to 5% is usually what we look at. But there's just a lot of misinformation and lack of education out there. And as far as like understanding how much it's going to cost you, I've had one person in my 20 years at the closing table literally push away from the table and say, I'm not signing anymore.
Wow.
And I was like, it was really awkward.
Yeah.
And you want to know what it was? It was the amortization chart. The amortization schedule, because and most people don't even look at it, but if you look at it,
it's terrifying.
It's freaking ugly.
Yeah.
I mean, but then you come back to, what is my alternative?
Yeah.
And that's where, hopefully we'll talk a little bit today about the all-in-one. That's where, that this loan that I've learned about and been focusing intently on has changed the whole landscape of what I'm doing. So
yeah, and I wish I am a veteran, and so I get preferential rates and no PMI and zero down, all this stuff, which is good and bad. It definitely helps out veterans, and you can get into a home much easier. I don't think I ever would have qualified early on in my life without that program. So it was super, super helpful. It's kind of unfortunate they don't have more programs like that for the everyday person. I understand, it's a benefit, and but a lot of people, it's very hard to get into home ownership.
And unfortunately, I think it's going to get harder and harder, in certain regards. I mean, we're definitely seeing, I think at CMG, we now have 937 loan programs and counting.
Wow.
So there's a plethora of, and why is there that many? Because everybody's scenario is different, right? Yeah. Everybody's situation is different, and there's different, guidelines and caveats and all the different things. But but the main frame of the amortized loan has not changed.
Yeah.
It's just really not changed.
I mean, obviously it's been around forever. Who do you know any history on the amortization or the 30-year fixed
a little
loan?
bit? Yeah. So I've been researching a little bit just recently. So the amortized 30-year loan came out in the 1930s.
Okay.
Which is right after the Great Depression, basically, and it was designed to give people, a longer term, right, so they could afford home ownership, and it did that. It absolutely has done that. But unfortunately, over time, there's not too many things that I can think of in history that have not evolved, in American history that have not evolved since 1930.
Yeah.
And yet we don't have a lot of people questioning that.
Yeah.
That's what's wild. And so we're all conditioned to chase interest rates.
Yep.
Why? Because that's the only way we can affect the amount of money that we're spending on a mortgage.
Yeah.
That's the only way to affect and impact that. So it
And yeah, I was the guy who chased interest rates, but unfortunately, I would chase the interest rate, and I'd be like, yeah, I got a 3.75, which is amazing nowadays, but they can qualify me for this 2.75 mortgage now. So I refinance the mortgage, my 30-year. What you don't realize is you're starting the amortization schedule all over again. And all that interest is starting all over again.
The highest. So you bring up a good point. And this is what's it's an absolute travesty in my line of work, is that right there.
Yep.
You didn't. So that loan officer, whoever, and forgive me, I'm not trying to be critical of the loan officer, but I kind of am.
Yeah.
In regards to, they didn't even make that clear to you.
Yeah.
Right. Now, we have to take responsibility as a consumer as well, but also you're hiring a professional for a reason. So we sit there and we chase these rates around. And again, I'm guilty myself personally and professionally.
Yeah.
But I can tell you I've taken a little bit different approach professionally in regards to that when rates came way down. But we kick it back out to 30 years and look at all this money you're saving monthly.
Yeah.
But what you're forgetting is you just reset back to the highest interest bearing portion of your mortgage, which is the first 5 years.
Yeah.
You're barely touching your principal during that period of time. So if you refinanced which the cycle is every 3 to 5, maybe 7 years, where we're chasing these rates again. And we just keep going around this merry-go-round. We kick it back out to 30 years, start that over again. What I started doing, because I saw the numbers and I didn't feel good in my soul about it.
Yeah.
Especially because a lot of people that I was refinancing when rates went down into the 3s and whatnot a few years ago, I looked at and I went, I just financed for these people. So I feel like slimy.
Yeah.
Because I literally just did. And now, could I control the rates? No, I couldn't.
No.
But the only way that made me feel good about it is by being a good fiduciary for them and helping explain. So I refied them into 25s and 20s and still saved them a lot of money monthly, but also saved them. And I have a technology that shows them how much the difference between 30, 25, 20 side by side comparisons. And so I was able to do a lot of 25s and 20s. So that made me feel a little bit better about the fact that I was hey, I just financed you a year ago. Yeah. Welcome back.
Welcome back.
I love it. I made great money during that time, but I still, again, my business has truly been built. My behind the scenes that's become very in front is serve others before myself.
Yeah.
Anyway,
and that's where you're going to get repeat customers and build that trust, because people aren't stupid. I know the mortgage guy that I go to or used to go to. Now you're my guy, but it's like, they don't even bring up to the fact that, yeah, dude, you're saving yourself, $200 a month by refinancing, but it's going to cost you $40,000 over the course of this loan. It's slimy.
Well,
I don't
another
like
thing
it.
that is I think important, with choosing a mortgage professional is okay. So maybe you do choose to do that because financially in the position you're in, maybe but why is it a good decision to do? And if you're saving $200 on this, what are you going to do with that $200 to make a deeper impact. So for instance, there was people that I did kick it back out to 30 on, but the savings we were using to attack other debt.
Yep.
And that other debt freed up more money and saved them more in the long haul. So there's just, again, there's just like in any business, right? There's people who are really not very great at what they do. They don't care. There's people that are okay. There's people good. And then there's people who are great.
Yeah.
Right. And it's about trying to find those that are great and truly take pride in what they do. And it's not just about a paycheck, but the beauty for me, and this is what I learned really early on, is when you serve people like that and you change the whole trajectory of their financial picture, guess what? They're going to refer people to you.
Yeah.
And it's going to go over and over again. And sometimes it is having the conversation. This is not in the best interest, your best interest.
Yeah.
This is not, yes, you're saving monthly, but it's going to take you 10 years to recoup the cost of this refinance. I have bless his soul, I have a veteran, older gentleman that I financed for here recently in the within the last couple of years in a higher interest rate environment. And he gets these solicitations all the time in the mail that are just, they're messed up. Veterans are hit harder than anybody else. And I forewarned him. So I said, anytime you question it, just give me just shoot me a text, give me a call. It's almost every freaking week. This guy is saying, hey, have rates dropped enough to make it? I'm like, I'm telling you right now, we're not even close to making any sense for you. Yeah, maybe we can get you a lower rate, but at what expense? It doesn't make sense. I promise you. Trust me. I make a living. I want to make
why does he want to refinance?
He just wants a lower rate so bad.
What's he at right now? Terrible.
I feel like it's not for the current market. I feel like he's like at 6.
Okay.
And
stick with it for now, buddy.
Right? Yeah. It's not that. We're not there.
Yeah.
So anyways, it's just, it's funny. But again, what's the media telling us?
Yeah.
That what are they saying? They encourage us, and we have bought in and drank the Kool-Aid of chasing around interest rates. And we've not just circling back to the history, right? We have not questioned why this thing has not changed since the 1930s.
Until now.
Until now.
And here we are. And now that's kind of why you're here, is the all-in-one loan.
Yeah.
What is this product?
Yeah. So, man, it took me a minute to get this thing. So again, because not only am I a consumer who's chased rates, I've helped people chase rates in my career, because what's been the alternative, right? So when I got a hold of this loan, the all-in-one, it took me a minute to wrap my head around how this was even possible. It was like too good to be true. And wait, how? So the concept of this thing is it's a if you look at how credit works. So you've got amortized loan is a term loan. Okay, it's termed out. You pay this interest rate for X amount of time, and it's going to get you paid it off. You're going to pay it off. If you throw extra at it, you'll get it paid off sooner, which will save you interest and yada, yada, yada. So we can control our mortgage 2 ways: lower interest rate and pay extra, or a shortened term. Now, the problem with both of those concepts is, and what keeps most people back from doing that, is fear. What if I need the extra money? Okay, so put the interest rate aside for a second. As far as paying off your mortgage early, if I pay extra principal, what if I need that money?
Yeah. Can't get it.
You can't get it, right? Or if I do a 15-year mortgage, right? That's like a ginormous payment that I'm tying myself into. So if life throws the curveball, I'm stuck.
Yep.
And in my career, I've bailed people. I've gotten people into 15 years that had to have it. And then business changed, their life changed, and they're coming back going, I can't do it. I gotta kick it back out to 30 years. And that was not fun. For me, that was not fun, because I felt like I didn't do a good job, because my job should be, with what I can control anyway, is putting people in a product that lasts as long as possible, because that's where they're going to save money.
Well, and a lot of problem with that is that if you do develop financial hardship, and you're going to get a mortgage, now all of a sudden you don't qualify for it because something's changed. Your income's gone down. You don't have access to that money. And so,
which is why your interest only loan and everything back in 2008 and all these adjustable rate mortgages and all the wild, wild west, we called it, that was going on back in the
dual, no, what was it was the no income ninja loans.
Yep.
Yeah.
And again, I'm a strong believer in, loan products are vehicles. Okay. They're vehicles to accomplish whatever goals you're trying to accomplish. And if used appropriately, an adjustable rate mortgage is freaking fantastic.
Yeah.
Okay. But if used inappropriately, as they were then, which by the way, they can't really be used that way anymore. I mean, the people can't even qualify the way they did back then. There's lots of restraints to that kind of situation. It set people, oh, don't worry. We're just gonna refi you.
Yeah.
And then what happens, like you say, that's part of what got us in trouble is they couldn't refi.
Yep.
So now what do you do?
Yeah. Price go down.
Yeah.
Your property value goes down for whatever reason.
There's just in the amortized loan, there's just not a lot of freedom. There's not a lot of flexibility. And so getting back to it, so you've got a term and then you've got revolving. Okay. Revolving, as most people are familiar with credit cards, are revolving. Yep. Okay. So you have a limit on a credit card. If you use, so you've got a $5,000 limit, you used, $2,000 on it. Your payments based upon what that balance is based upon the interest rate. If you pay it down, the payment goes down, your minimum payment goes down a little bit, and it revolves around. So the more you pay it down, the more you can kind of snowball pay it off. So it actually does affect, when you pay extra, it actually does make your payment go down because it's revolving.
Yep.
It's not termed out. Okay. So the all-in-one is a line of credit, and where it gets kind of interesting is it's fully integrated with a checking account. So it's a loan that literally allows you to use static funds, okay, that we all have in our accounts all the time while we're waiting to deploy into bills, right? We have how much in our checking account all the time. Why? Because we need it there in case we need to pay bills. Well, that money, because it's fully integrated with the line of credit, is literally paying down the balance on your mortgage the moment that dollar amount hits your account. And then it gets really cool when I tell people the interest is calculated that night.
Dang.
At 9 p.m. and swept away. And it happens every day that way. So now it's no longer a figment of what's my rate. It is, how is my interest calculated? And my interest is now calculated based upon money that I have in my account. So it fluctuates just like it would on a credit card, thus saving you and allowing you to, it's the only principally first paid mortgage in America. So literally when you deposit those funds, it is going towards your principal. And here's where I got hung up. I was like, wait, I'm not going to put this money towards principal because I'm commission paid. What if I have a bummer of a month?
Yeah.
I need that money.
Yep.
And I was stuck. I was like, because I was stuck in the amortized, like if I pay extra, it's locked.
It's gone. Yeah.
Well, this is fully accessible. That's so the more you pay down, the more you have access. You don't lose access to any of it. It's a 30-year draw period, 100% for the first 10 years. And then after the first 10 years, every 5 years, it diminishes by 25% so that by year 30, it's at zero.
Can you use this? Is this for a primary residence only, or is it for any mortgage?
Yeah, good question. So primary, second home, investment, and even construction. You can even build a house with the loan.
Damn.
Yeah. So I just not actually using it for construction, but I have some folks that own their home free and clear, and they wanted to build their dream home in Bandon on the coast. And their home is here on the river. It's free and clear. So I said, hey, here's what we're going to do. You guys are going to be your own bank. Here's how. We did what we call a cash out refinance using the all-in-one. They pulled enough money to pay for the land in Bandon and get their contractor going with all the prep work that's needed. So all of that adds up to about $500,000. And they're literally the ones that are writing the checks. Because if you're familiar with construction financing, you have draws.
Yeah.
The bank is giving you draws based upon completions and inspections and all these things. Well, they now are their own bank because of the equity they have in their home. And they're not pulled. They didn't pull like a normal cash out refinance. You're literally, if you get the loan, you're pulling all that money and you're paying interest on all that money from day one.
Yeah.
Well, this is allowing them the accessibility to the equity, but they're paying it as they go, just like a construction loan, giving them full control. Meanwhile, they have pretty good they're retired, have pretty good retirement income.
Mm-hmm.
So every dollar into that account is paying down their balance that they've already drawn and given to the contractor, thus giving them more access to more funds as they go.
And when they're done, they're going to have a home in Bandon that's free and clear.
Sell their house,
Yep.
right? They'll pay that off, and yeah, they'll be free and clear on their place in Bandon if that's what they choose to do. And actually, these guys are so in love with the loan, they won't. They'll actually, they're actually going to have, they're going to do an all-in-one over there too. So they have access to funds, because the other beauty of the loan is when you're down to zero, you still have access to all those funds.
Mm-hmm.
So if you're retired or self-employed or whatever it is, you now have access to supplementing retirement through the equity. So how many times do we hear, people, boomers or whatever, that they own their house free and clear.
Mm-hmm.
And they're poor.
Yeah.
Because their Social Security isn't enough, their pension is okay, and they're struggling, but yet they own this house that's worth $500,000 or more.
Yeah.
And what does it mean? Because they can't do
nothing.
With
They don't have access to that money. And I'm not so bright when it comes to mortgages and finances and everything. I'm doing, I'm the guy who's like, pay off all your debt and don't have any debt and have a ton of equity that you'll never touch. Meanwhile, I could use that for building wealth and building retirement and stuff like that. But I'm the guy who's terrified of touching it because, I finally listened to my grandmother, who was, 90 years old, and it's like, pay off your house and have no debt. Great advice, Dave Ramsey advice.
100%.
But you're not going to be able to build wealth on it. So how do you talk to people who are scared to touch that equity?
Yeah, I mean, some are just not. It's just not going to be something that's not for everybody, right? Because there is always risk with things. But it all depends on just getting down to the bottom of what is the true goals of what you're trying to accomplish, right? Where are you at in your life? Are you trying to get to retirement? Are you trying to create freedom? What does freedom look like for you? And so again, it's those psychological barriers, which is where my psychology comes in. Just trying to break down what is the true why here.
Yeah.
What is the true why? So when people, I'm a huge fan of being debt free. So I love the Dave Ramsey concept outside of, obviously he doesn't necessarily believe in the mortgage per se. But I think that's a reality for most of us. Most of us are
not paying cash.
Yeah. And so the reality is we're going to need a mortgage. And so I'm going to help them do that in the best way possible. I work with everybody to get as debt free outside of that as humanly possible. Mm-hmm. Now that I have the all-in-one access, I'm able to exponentially speed up the ability. I mean, we're looking at the simulations that I do for people, depending on their circumstance. It's not for everybody. They're paying off anywhere from very conservatively half of the time to most of the ones that I've done recently are anywhere from 7 to 5 years. In other words, they're paying off in 7 to 5 years, not 7 to 5 years early.
Yeah.
And it's like, whatever. Yeah. Okay. And I mean, you've seen the simulation.
Yeah.
It's a real deal. And when I do them, I often will back up and I show people a side-by-side comparison in our simulator. The numbers don't lie, right? And you see a 30-year versus the all-in-one, and you see, and I just say, just digest that for a second.
Yep.
And I just let them do that. And then I ask them the question, how in the heck did that happen?
Yeah.
It's
the interest. It's the not amortizing your loan, because I know with me, when I started out my current mortgage, I mean, my interest was $800-900 a month. That just disappears. I mean, that's a lot of money every month for 360 months.
Yeah.
Obviously it goes down,
Sure.
but it's all front loaded.
Yeah. And don't get me wrong, you can do the same thing like you've been doing. I know your circumstance, you can achieve a lot of the same thing by throwing extra principal at it. But I'll tell you, 3% of society does what you've done.
Yeah.
Why? Because of what we talked about earlier, the risk.
Yeah.
The risk of what if I need those funds? And so, getting to a point of being free and clear is freedom.
Yep.
Right? It's freedom. But having the access, I ask people, what happens if you're in an amortized loan and one of you, talking to a married couple, what if one of you loses the job?
Yep.
What happens if
I fall off a ladder? That's my,
right. What happens? What are your options? You better freaking figure something out really fast. You don't have any well, you've got $300,000 of equity.
Yeah. Good luck.
What does that mean?
Nothing.
It doesn't mean anything unless you come to me or somebody like me and get a refinance or whatever. But can you now? Because you just lost the job. So what ends up happening, you probably lose your house or you're forced to sell it. And then how are you getting something you see there's a problem there.
Yeah.
So this loan creates a situation where you're so quickly paying down your mortgage, but you don't lose that access. So and this is a great time to tell you, it's never had a default.
Wow.
It's been out since 2005. The loan's never had a default. Why the heck would that? How can that be?
Yeah.
How can that be? Life throws us curveballs, right? Well, it's because of when you're doing good, you're doing good. And when you're doing good, that mortgage is working for you and paying down. And if something happens, God forbid, a loss of a job or a death in the family or whatever it may be, there's access to that now.
Mm-hmm.
Or how about good? How about good? How about we want to take a trip of a lifetime with our kids before they're out of school? How can most people do that? The biggest asset we have is our home, right? You have access to being able to do that, and you've saved so much money. It has an impact.
Yeah.
So.
I'm kind of curious about, so this product is a 30-year product and it decreases every 10 years. Say you pay your house off in 5 to 7 years, you still have that loan accessible. You treat it as a checking account. Obviously, you don't have to put all of your money in there, but if you do keep throwing money out in it, is there any kind of reverse where you can make extra interest on the product?
Yeah, that's a really good question. I don't believe so. Once you're free and clear, you're just going to be, it's normal checking account,
Yeah.
FDIC insured, all the things. So it's just going to act like any other checking account.
Yeah.
Where you're going to just stack up funds. Now, if you're in that position, and this is what we work with financial advisors on, is, okay, if we're going to get you to paying off your mortgage in a fraction of the time, now what?
Yeah.
Okay, now what are you going to do? What's your next plan? The next plan, and this is in the simulator too, is by investing that same amount that you were spending on a mortgage, by putting that, because you're already earmarked it, okay, by investing that, how much are you able, now the financial advisors involved, how much are you able to compound interest affect your financial picture? It's crazy. It literally shows, you can put in whatever you want, but it defaults to like a 5% rate of return on an investment and 3% appreciation. And it shows how much net worth goes up in comparison on a 30-year, because everything's 30 years.
30 years, yeah.
So in comparison, so you get it done in say 10, and you have 20 years of investing, or however you want to do it. And what does that do for you? It's crazy.
Can you use this? I don't think I heard you say on like investment properties for rentals, or
so use it, meaning can you
buy a rental with the
all-in-one?
Yeah, you can.
Yep.
Wow.
Yep. So, which also makes those cash flow more, because again, it's revolving. The more you put in there, the more your payment is going down. So that means that your property, your rental, is now cash flowing more and more each month, and it snowballs itself. So I have some people that will buy with the all-in-one, an investment property with the all-in-one. Okay. And maybe to begin with, maybe they're just breaking even.
Mm-hmm.
Okay. And then over time, they increase rents, whatever. And they're taking their rents and they're putting that back into the account, right? That's lowering that mortgage and all their rents because maybe they make a good living and they don't need the rents
Mm-hmm.
to survive. Okay.
Yep.
So they keep, and it just snowballs itself down. The more rents, the more the payment goes down, the more cash flows, and it just winds itself down.
What, I mean, do you need to come into this thing with a ton of equity in the property or a bunch of money down, or what's kind of,
Parameters.
yeah,
Yeah. So
parameters?
primary residence purchase, you're looking at 10% down.
Okay.
And so that's the minimum on a purchase primary. Okay. So, and then as far as a refinance primary, which is what I'm doing this myself, 80%,
Okay.
because it's deemed cash out.
Mm-hmm.
Okay. Now you could go to 90% if it wasn't cash out, meaning, maybe you haven't had your mortgage for very long and you owe like 90%, you could go rate and term to 90%, but so cash out to 80%. So do I need to pull money to 80% on my property? No.
Yeah.
So why am I doing that? Well, I'm doing that and I'm going to max it because now I'll have access to all this extra cash. So for me, I'm still in build and really recoupment mode. I need to be able to take funds and go inject it other places to have that money make me money.
Mm-hmm.
And so now you're compounding your impact. So again, I don't knock people for paying off their mortgage and just being debt free. There's a lot of freedom in that. But for people that are still in a growth mode of trying to accumulate so that you can take your foot off the gas and create, a legacy for your kids and grandkids and whatever, and you're still in your money making years, like that's when you put the, pedal to the metal and you're able to leverage to do these things. So,
Man, it's a lot to think about
Yeah.
for, but
It
it's
is.
it's just such a new product that it's not that new. It's been around.
It's not a new product, but it's a new concept.
Yeah.
And it's the only true one of its kind that's all, I mean, there's concepts like this. I think it's velocity. They call velocity, lending or something like
Yeah.
that, where they use a line of credit and they do this, but it's pieced together. So this is the only product that actually has the fully integrated checking. It's literally all in one. There's no more, it's called all in one because you should never need another mortgage.
Yeah.
There's literally no reason to have another
And
mortgage.
this is run through CMG.
Yep.
And are they the bank, or how does that?
Yeah. So right now we have a partnership with a bank,
Uh-huh.
that helps us. There are actually two banks, one with construction and one, the construction all in one, and one with the normal ones. But we have recently acquired a bank, and it's there's a lot of legwork there, but so soon, it will be completely CMG controlled, meaning our bank, the whole thing. But right now there is a partnership with a bank that handles the checking part of it.
All right. So if I'm, 20-year-old me, just starting out, never had a mortgage, or to those people listening who are just kind of getting into this field, what's a couple pieces of advice you would give them?
Yeah, so that's a good question. I often think about, man, if I only knew back then what I know now,
Mhm.
right? And so hopefully we teach our kids this way. But so what I tell, I help teach a course at St. Mary's from time to time, and anytime I can get in front of young kids, I say, buy a house as quick as humanly possible and house hack, meaning rent your rooms to your buddies.
Yep.
Okay. Have them help you make that payment, and then stay there for 12 months and then rinse and repeat.
Yeah.
Do it again. And man, if we would have done that, back in the day, we'd have a harem of rentals.
Yeah.
And that if, even with, the big financial bust in 2008 or whatever, nine, if you're able to hang on during that time, you still won with real estate.
Yeah.
And we're way on the other side of that now, where we can literally say that was the worst thing that any of us could have ever imagined. And at the time was like, gosh, this whole real estate thing. And a lot of us still bear the wounds from that. But if you really look at it, if you were able to hang on, you still won.
Oh yeah.
So a 20-year-old, get in however you can and get people to help you until you're tied down and have the wife and the kids and all the things where you don't have the luxury of renting out rooms.
Yeah.
And having to have, a certain place, like, buy a place and have people help you.
I know a lot of kids are going to be like, well, there's no way I could ever afford it. Real estate's so expensive. I mean, there are programs out there, like you said, 3 to 5% down.
Yeah.
If they can't get into the all-in-one for whatever reason.
Yeah.
There is other programs out there, and then eventually you can get into one of these all-in-one loans as well.
Yeah, we also, another proprietary product that we have at CMG is called our Home Fund It, and Home Fund It actually is crowdfunding for a down payment.
Oh wow!
So kids can literally, you could gift Johnny off the street up to $5,000 to buy his first home. And there's no limit on how many people do this or how much you raise. The limit is 5,000 per individual.
Uh-huh.
But I mean, you could do it for $5.
Wow.
And so they literally can start. I mean, you can be in high school and start raising funds for your down payment. You get a website that's free to you, and we match $2,000 up to $2,000 for a first-time home buyer. Furthermore, there's another component to this called Up It. Where corporations that we've partnered with, like big corporations like Target, Walmart, people like that, if they can talk people into buying say they shop online for Walmart and they have their groceries delivered or whatever, grandma does, okay, and Johnny goes to grandma and says, hey grandma, would you go through my website to go to Walmart
Mm-hmm.
and it's not costing you anything more, it's just one extra step. Go to Walmart, do your shopping through there. Walmart's gonna match X percentage to go towards that down payment pool.
That's a cool program,
right?
Whoever came up with that,
Us,
that's awesome.
Our company. So it's super awesome, because what's the biggest obstacle most have in buying
down payment?
Yeah,
right?
Down payment.
Yeah.
So it helps people do that. One of the cool ideas I think is like, okay, you're getting married. Okay, you're going to get married, but you really want to own a home. So you tell people, hey, instead of the registry to get me pots and pans and all the stuff that I can get hand-me-downs for, I want you to help me with my down payment. So then we're going to put a QR code up at our our parties and our get-togethers and at our wedding.
Yeah.
And all you have to do is scan it, and you can gift us money towards, instead of our honeymoon or the things for our house, to actually getting a house.
If I had one piece of advice for somebody getting married, don't spend all your freaking money on the wedding, dude. It's a complete waste of time. 100%. Nobody's going to remember it. You spend 10, 20, 10, 20, 30 grand on some of these weddings, and use it for a down payment on your house.
Yeah.
Or just save it in the bank or whatever, because you're going to be, down the road 5 years, you're going to wish you had that money. So.
Yep. 100%. Yeah. I couldn't agree more.
Mike, if people want to get a hold of you, what's the best way to get a hold of you?
Yeah, you can find us online at newmangroup.com. That's my team name. We're on all the major social media channels, Instagram, Facebook, LinkedIn, and whatnot. But our number is 541-227-2727. And we can be emailed at the Newman Group at cmghomeloans.com.
Right on. Mike, I appreciate you taking time and explaining the all-in-one loan. It's an awesome product. I'm going to be pushing it out to some people that I know that could benefit from it. So thank you, everybody, for watching. If you found value in this, please share it, and tune in next time. Thank you.